They say that for every new restaurant that is opening up in India, there might be two that are shutting down. So therefore, the question comes about: what does it take to build a highly successful, long-lasting restaurant brand that not only opens every single week, but keeps on doing that year after year? Well, we got the perfect gentleman to answer that. The guy who runs McDonald's and who owns the two geographical franchisees in India, which is West and South in Westlife. And the name has changed, of course, Amit Jatia. He joins in right now to talk about their Vision 2027 and a lot more. Amit, great having you. Thanks for joining in.
Thank you very much for having me.
And it's a fabulous store out here in Worli.
Thank you.
I mean, you call it an experience store for me, and I've been to a number of stores, but this is certainly an experience worth beholding.
Thank you. It's one of our newest stores and a good 4,000 square foot where we can give the full McDonald's experience to our customers, including experience of the future.
Yeah, and it is like that because the experience that I have here is a lot different from what I'd envisaged I would have when I entered the store.
Oh, okay.
So
good. I'm
stuff.
happy to hear that. Thank you.
Yeah. Okay. So Amit, let's talk about the grand picture first. I'll come to the Vision 2027
Sure.
and all of that also. But I'm just trying to understand. When I speak to a lot of people who are constructive on the QSR space and on your business, they cite global examples, they cite global sizes and of populations which are way lower than India, and then say that you could almost argue that a McDonald's or any other brand is still in its infancy. How do you see this when you think about it?
I definitely think that we are at the start of the QSR revolution. It's taken us 20, 25 years to get there. But remember, when we started in 1996, forget the question of the ecosystem, but even the frequency of eating out did not exist. So in the very early days, even up to 2002, 2003, we would say that our competition is really the housewife. Because if out of 100 occasions of eating, 97 are at home, then really who are you competing with? So the whole idea was what would make people eat out more often, and of course it's beyond QSR. It's about the whole urbanization of the country, and it meant working moms. It meant the kind of life that we have in a city like take Mumbai, where people don't have the time to cook, nuclear families, growing income levels, and seeing the global world as well. So all of that led to frequency being 3 times to even today it's only 12 times in a city like Mumbai. And if I were to compare that with my Asian counterparts, I'm not even talking global markets. We are talking 25 times a month. Some markets are 40 times a month. That means you are eating out twice a day effectively, many times. So I do believe that India is a young population, and all of these trends that are coming about, as QSR is coming of shape, as more and more brands are penetrating, particularly also the growth of the 3POs that have made consuming outside food at home so convenient. I mean, at the click of a button, you're sitting there, you're relaxing on your chair, you think about having some food, South Indian, McDonald's, whatever it might be. You press a button, 30 minutes later, it's there. That convenience also drives consumption. So I think it's just the beginning. The frequency of eating out, the youth, the discovery of the advantages of having brands like McDonald's in the country, they're yet to be explored. So I think, as I said, the picture is just beginning.
Interesting. Where do you see your brand within that? Because it's an established brand globally, arguably the leading brand, so to say. And judging by your vision, which is for the 5 years as well as for the longer term, I would suspect that you would believe that while you're expanding, the runway is much, much longer than that.
Absolutely. What we've learned, firstly, if you take the city of Mumbai, when we mapped Mumbai in, say, 1996, 97, in our early days, let's assume we thought that we can do 50 restaurants in Mumbai.
Right.
Right? Today, we already have 100, and we think we can have 200. By the time we get to 200, it's going to become 300. So, for example, what happens is as the brand's more visible, and particularly a brand like McDonald's that's all-day dining, yeah, you can have breakfast, you can have coffee, you can have desserts. The good news is something or the other about McDonald's connects with somebody or the other. Yeah, what I mean is that you might like breakfast, somebody might like a burger, somebody might have coffee. Yeah, so in some way we connect with everybody, and when we are able to bring somebody into the restaurant, they experience more, and that brings them back again. Also, you see, cities are growing. Like, who thought that Borivali was the end of Mumbai in '96? Today, Virar and Vasai, and I think it's going to extend beyond that. And then again, if you look at Mumbai, Pune, I kind of look at it like New York and New Jersey. I think as roadways continue to get better, Mumbai, Pune is almost going to become one. And so just on the expressway from Mumbai to Pune, which earlier in '96, let's say, was zero opportunity. Today we have 5 or 6 restaurants on the way to Pune, and now Pune has another 30. So my point is that yeah, add all this urbanization is going to happen as income levels are going to grow. The crux being that India has to grow for us to grow. It cannot grow in isolation.
Sure.
Of course, it can grow a bit in isolation, but not at the pace that is possible if the country grows. And what I'm seeing is that India is really on the right path. And I can see very good growth. I'm very positive about where we are heading.
Okay. Um, a word on the numbers. I heard you mention the number of restaurants you have in Mumbai. Now, can you tell us what's the overall restaurants that you have classified, if you can, geography wise? The reason I asked this question is I remember a conversation that we may have had a few quarters or a few years back. I don't remember what, wherein you had told me then that there are a number of places wherein you were still opening up your first restaurant.
Yes.
So, what's the status now in 2022, and how do you expect it to be 5 years out?
Sure. So you see, things keep evolving and changing, and therefore, what was true 10 years ago is not true today. And I'm very certain it won't be true day after tomorrow. I'll explain what I mean. We started with Mumbai. We built our cold chain, our supply chain, our ops, and everything around Mumbai. Yeah, at least from our point of view in Westlife and Hardcastle, we went about it quite systematically. After Mumbai, we went to Pune, Ahmedabad, and so on, and we built a circle. Yeah, then as late as 2004, 2005, we planted the first store in Bangalore. Yeah, people were telling us we are crazy. How can you ignore a market like Bangalore? But it was not about ignoring Bangalore. We knew we were going to be a bit late, but we had to get the foundation right. The minute we planted our first seed in Bangalore, yeah, we kept opening in Bangalore. Yeah, before we went anywhere else. Today we have 45 restaurants in Bangalore, and we compete on a very strong basis with our competition. Then we went to Hyderabad and Chennai and so on and so forth. Similarly, we keep expanding our footprint in a systematic manner. So, for example, one day, few years ago, just pre-COVID, we extended the footprint to Nagpur, which is right in the center of the country effectively, and then to Raipur and all of that. So every time we open a store in such markets, then the adjacency around that starts becoming available to us. Our cold chain gets extended, infrastructure, operations, people, training, all of that starts getting built. And therefore, in other words, yet we are only in 40, 50 cities. Yeah. So therefore, you will see a lot more
What's the
McDonald's.
scope?
The scope is 120, 130.
Okay.
And therefore, you'll see a lot of cities where it'll be the first McDonald's.
Okay.
And, just to give you an example, very recently we opened in Ahmednagar, we opened in Shirdi. And what we are doing when we are going to these smaller towns, as I call it, global world, these are big towns. So I'll take Valsad as an example. We opened in Valsad, we opened with a freestanding drive-through. And the kind of response we got, 30 car parks, a beautiful drive-through McDonald's experience with a McCafe experience of the future. It just exposes the city to a whole different experience. And therefore, what we are saying to ourselves is that when we are putting the first McDonald's in many of these markets, can it be an experience that completely redefines their eating out experience, right? And then our point of view is that is what they will expect from the rest of the industry. And we are at least hoping that we sort of set the new benchmark. And as we are building experience of the future in McCafes, it will push the whole industry to invest and sort of keep up with what we are trying to do. So we think it kind of works quite well that way.
And you reckon that while you are upping and sprucing up the experience, if I can call it that, the resultant margin per store, if you will, at some in a short period of time, would come back to what you all erstwhile enjoy, or maybe improve upon that?
Yeah. So we've recently talked about our Vision 2027.
Yes.
But that kind of takes me back to 2016 when we laid out Vision 2022. For a brand like McDonald's, yeah, it's about average sales per restaurant per annum.
Yes.
In 2016, we were at about 40 million rupees per restaurant per annum. And essentially, we had said we will get to 60 million plus by 2022. And actually, we did deliver that. So what at that time, the margin was about 5.9% EBITDA. Today, we are at 12.8% EBITDA. So as we've been able to grow the average unit volume, yeah, we've been able to grow our margin profile. Along with that, though, the brand has also changed, and I'll explain what I mean by that. So, for example, there was no McCafe, there was no experience of the future. We did not have fried chicken. So now, when we open a new restaurant, the average unit volume starts pretty nice.
Okay.
Yeah, if earlier it was at the 40 million, today it may start at a 55 million, and therefore the margin profile starts quite strong. But our ambition is yet to take this, 60 million average unit volume per year to about 70 to 80 million. And as we go towards that, the margin profile will continue to get better.
Okay.
We are looking at strong double-digit EBITDA margins.
Most certainly. So, okay, since we've talked numbers, let me get into numbers. Then we'll again come back to strategy.
Sure.
Vision 2027, 2027. You are targeting strong growth, and my math suggested anywhere between 15 to 18%, depending on what number you reach there,
Sure.
over 5 years CAGR. At better margins, I think you said pre-Ind AS it will be X, and post-Ind AS it will be
Correct.
Y. So tell us about these growth numbers, and again, I mean, it's a virtue to be conservative and
Right.
beat the vision.
Right.
You reckon that's what you set out to do this time around as well, or is this a target which will be a challenge for everybody involved in McDonald's? Because I heard you tell me before the show that a bunch of your employees are with you for the last 15, 20, 25 years.
Correct.
So tell us about this target.
So at Westlife, for brand McDonald's, our belief is
Sorry. Yeah.
it's about bigger, bolder, and better McDonald's. So we set audacious goals, and we've done this from 95, 96. Otherwise, in a country like India, to survive 25 years later and actually get to making money while investing in the ecosystem, that's a big differentiator, right? I mean, thousands of crores have gone into setting up supply chain, and that actually extends the payback periods and so on in the early days. So we've set up a bold vision. The idea, I think it's a doable vision. So we don't want to talk, at least publicly, the numbers that we feel are not doable. These are stretch targets, but then these are the multiples we enjoy as well. So internally, we think about it. We say that the market, our stakeholders, see us as a growth brand, right? And we have to deliver on a growth brand. Yeah, when you're talking growth brand, there are two things that they're looking at particularly. Yeah, one is top line growth, and therefore anywhere between 15 to 20% is a minimum for us to deliver to our expectations. On the profit side, we do believe 15 to 20% because there is a bit of a catch up that we've been doing. And the reason for the catch up is that the upfront investment in the foundation was very high. Yeah, but today now we are getting the benefit with every incremental store. The payback that we get and the return that we get is now going straight to the bottom line. So we think it's a deliverable goal, but what's the point of not giving a stretch target? I think there's no fun in it.
Yeah. No, so where I was coming from, Amit, was this, that if I look at the numbers that you gave me before, the number of cities that you can reach out to, the number of stores per city that you can open, I think the store addition target by you is you may, I mean, so what I want to understand is this a responsible growth target, or is it an aggressive growth target that you set for yourself?
I think it's an aggressive growth target, but I'll explain why. Yeah. Now, when we do real estate, as I mentioned to you before the show, that for us, real estate is about real estate competitive advantage. Yeah. So when we do a real estate transaction, firstly, the portfolio of real estate has to be quality. And what I mean by that is we look for drive-throughs, we want high street, we want malls, we want food courts. And that's the sort of portfolio that we look for. Now, suppose I were to go into food courts, yeah, and then let's say there are 50 malls coming. Opening 50 stores is left hand, right? Because in a food court, it's obvious, it's easy, investment is low, and mall is driving that. But that does not build the brand. The other extreme is doing a drive-through, where you start by acquiring land, 15, 20,000 square foot, building the building, and so on and so forth. And that gives us long-term real estate competitive advantage. Today, we are the only brand with the largest number of drive-throughs in the country, in my belief. Now, the second component is the deal structure, right? Many times we enter the market early, so we've got to work with the landlord accordingly. So, given that our paybacks are what they are, we typically do 20 to 25-year transactions with our landlord, right? The landlord has to invest in the property. So, it takes a bit of time for the landlord to understand who we are. But the big advantage we now have is after 25 years, there is a reputation that we built for Westlife. Yeah, that one, we honor our commitments. Two, when the deal ends, we respect that. We work with the landlord. So far, we've been able to renew most of the land deals as well. And that's the faith that the landlords have in us. So, if you want to do real estate right, I think this is the kind of growth one can achieve.
Okay.
This is not what we are saying is not 1,500 square foot restaurants. They are not 5-year deals that you walk away after 5 years
Okay.
and all of that.
So you were saying you do large transactions, as in large space and for longer period of time.
Exactly.
And people are willing to do that very, very
With
easily.
us.
Of course, yeah, with you. Okay. Okay. Great. The other question is the texture of this growth. So the top line growth is great, but you have mentioned in that guidance that you will up margins, you will up return ratios, both ROC, ROE, you will up the free cash flow conversion, and in some fashion, a lot of this will be reinvested into the capex. By virtue of that, I presume that all the capex is funded internally. Tell us a bit about that as well.
Sure. I go back to history a bit always. So in 2016, we came up with an audacious plan at that time. 2016 was a tough period, and we talked about Vision 2022, where we said that we are going to take a store base to 400 to 500 stores, and that meant a capex of about 400 to 600 crores. At that time, our cash flow was nowhere close to those kind of numbers. But yet today, when I look back, we delivered a cash flow of about 5.2 billion rupees, and all this growth was funded with internal accruals. That is the same ambition we have for tomorrow. We are looking at investing about 1,400 crores into building these right quality stores, and we push ourselves to not only generate enough cash flow to put back into this growth, but enough cash flow to get some free cash flow reserves that we can now start paying back as dividend as well. So we take the pressure on ourselves, and by so far the team is motivated, and that's the culture and the DNA of our organization to push towards that, and that's what we are looking at.
You must be scanning competition as well and the landscape. Are you the from a store count opening perspective, and I'm sticking to that metric alone currently, amongst the most aggressive? The reason I ask is because the scope in India is almost infinite.
Correct. No, I think from what I'm reading, competition has talked about much larger numbers. But I think you got to look at that in relevance to certain things. One of them being, at least what I understand from many of our competitors, are going for smaller sizes, and their average unit volume that they are currently at is about 30 million, 35 million. Now, while we are shooting for a certain size, which is about 3,000 square foot stores, and we are looking at an average unit volume of about 70 million rupees. So I feel that our paths are slightly different. Outside of which, my philosophy always is we respect our competition, we compete with them every way. So by no means can they be underestimated. And I hope our competition thinks the same about us. But my philosophy is in our boardrooms, yeah, we have to look ahead, and we have to look at competition in the rear view mirror. We don't get guided by what they are doing, but we keep an eye on what they're doing. The minute you start being guided by what competition is doing, you start following, versus if you have a clean slate ahead of you. So I would say that while I'm hearing bigger numbers, we believe this is what is right for us, but we keep refining ourselves as we go along. And if we believe that we can push ourselves harder, there's no question we'll do that sooner than later.
Okay. You must have scanned a lot of global landscapes where McDonald's is present. What are those one or two things that you believe you would love to emulate, both in terms of growth strategy or how they have gone about theirs, and you might imbibe here? I'm just trying to understand how would the Westlife McDonald's correlation evolve in terms of a customer experience over the course, or the growth strategy over the course of the next 5 to 10 years?
Sure. So one of my very, very strong beliefs is that particularly in retail and in a consumer brand, You have to reinvent yourself every day so that every few years you are unrecognizable by the customer. Okay. Otherwise, your brand will become obsolete.
Okay.
And we saw that happen to us a little bit in 2012 and 13. And since then, we started talking about what is called Horizon 2. And Horizon 2 is about how the brand will look in 12 to 24 months. Yeah. And then there is Horizon 3. How will it look 24 to plus months forward? Therefore, the question is that EOTF, we were the early adopters globally, right? So around the time when some of the major markets announced EOTF, we started the journey. We did not wait to see what competition's doing, but we said we're going to lead that way. Now, from EOTF, small changes have to be made every day. And currently, we've been focused around menu, right? So we've kind of embarked on a journey of what we call chicken leadership. And chicken leadership is not about 1 day, 2 days, and 5 days. It's about a long-term strategy where, along with burgers, like we have everywhere else in the world, we also want to be known for chicken. And for us, it was a building block approach where we first had to build credibility around what McDonald's was for burgers. Then very recently, I think a year or two ago, we launched fried chicken, bone-in chicken as we call it in South India. And the whole idea was, how do you do a differentiated platform?
To something that
And
is already there as well,
exactly,
right? Because there's a
because
Kentucky Fried
competition's-
Chicken out there known for it.
Absolutely. And they are very strong and very respected in that area. So we had to do a differentiated product. And I'm so pleased to say that the consumer feedback we have is fantastic. Our product is differentiated. And now we are going to use that as a building block. And then, of course, in burgers, we have a very wide chicken portfolio globally. And you will see us sort of build that. And as we continue to do that, it evolves in the consumer's mind. Even if you talk about McCafe from another dimension, I feel this is just the beginning. McCafe is a platform for beverages, right? So not only have we just started with hot coffee and cold coffee, but I feel there's a lot to be explored around smoothies, around ice blended, around food products in McCafe, which is quite different from the front counter. And I think that's a whole different game available to us as well. So what I can promise you, 3 years later, the way you use McDonald's today, right, will not exist. It'll be a different way to use it.
Okay.
Another sort of, if I paint a picture for the future, there might be no front counter. Now, how can you imagine not going to a front counter and ordering, right? It's all going to be digital.
Okay.
And therefore, you just come in, sit down, you order digitally, food comes to your table, the menu will be expanded, and the look and feel will evolve even further. That's the new McDonald's.
Pretty interesting. Okay, I look forward to that. You know, I'm glad I'll be able to experience the food tech, as I would call it, because I can't experience the chicken because of my eating habits. per se.
Similar to mine.
You are also a vegetarian.
Vegetarian.
Okay, fair call. 2 or 3 more questions. Yeah, one of them is around the sizes of companies globally versus the Indian, for lack of a better word, JV affiliate, whatever you call it. Now, when one looks at what McDonald's in a particular country like US has been able to do, whether in terms of market capitalization, but that's a derivative maybe, but more in terms of the revenues. You guys have become much bigger than what you were. But is that the kind of runway that you look forward to when you think of what you can be, say, 10 years out? I'm really asking you.
Absolutely. To my mind, being less than $1 billion sales company, I feel we are not doing justice to QSR and to brand McDonald's.
Yeah, but the timing is a
The
thing,
timing,
right?
see, in India,
Because you could hit $1 billion in 2040, but that won't be fun.
no, absolutely it won't be fun. And my point to you is that the way I'm seeing India shining now, my belief is it's going to be sooner than later. Or I mean, while we talk in our Vision 2027, we talk of 4 to 4,500 crores. In constant currency, that's $1 billion. And I don't feel currency should be held back against us. Because in 2010, when I became a licensee for McDonald's, the currency was a dollar to 45 rupees. Yeah. So my point is, if the currency becomes 100, then I need 10,000 crores to be $1 billion.
So let's break it up into rupee terms. I'm just saying.
No, in rupee terms, I tell you, I mean, when we started in 1996, the rupee was 31 to the dollar.
No.
So 3,100 crores is not very far away. We expect to close this year 2,300, 2,400 crores. and the 3,000 plus is coming soon.
Sure.
So in constant currency, we'll be $1 billion, but we also want to be $1 billion in real currency, today's currency, and that of course will take 4-5 years at least. But if India changes its trajectory, which I feel it's on the path, yeah, it will be much sooner than later.
So you're saying 4-5 years post 2027 is where you can be $1 billion in at current rupee terms, at current rupee to the dollar.
Well, I would say within the next 10 years,
Within the next
within the next 10 years, we should be in real currency $1 billion company.
Yeah.
Even if the currency moves to say 90 or something, point I'm trying to make is that the opportunity to be $1 billion business in currency relevant to that day is very much there.
Sure.
Second thing I'm saying is it's going to be sooner than later. So it may not be 10 years, it may be quicker.
Sure.
But for that, like I said, we are part of the economy. We are not the economy. So if the economy continues to ride like what I'm reading and seeing and hearing these days, yeah, I feel it's going to be sooner than later.
Yeah, no, the only reason I press upon it is because most people are saying that urban consumption will grow at a much faster clip than what the economy or average consumption growth rates will be. And which is why you might do better than the economy, even if the economy were to grow at less than optimum 6-7%.
Absolutely. So my point is, even at 6-7%, we will grow at 10-15%.
Sure.
That is not in debate.
Got it.
But finally, if it's at 4%, we'll grow at 8%. If it's at 10%, we'll grow at 20%.
Sure.
So finally, we are a function. But yes, our category is growing faster than the economy is.
Most certainly.
But what happens is that there's also a setback. If ever, consumers, there's inflation, then consumers then tend to hold back. So frequency drops. When frequency drops, it hurts everybody.
Sure.
We are not isolated. It'll hurt us less than others, but we are not isolated.
Okay. I love the sounds around this cafe, by the way. And viewers, I hope you can hear the mixies and the people chattering because it's great fun to do that. Last two questions. One is, top line is vanity, bottom line is sanity. Let me try and understand. You would do this clip of growth with, as you mentioned, better internal metrics almost consistently every year. I'm presuming that what you set as targets for yourself for 2027 would then become the base for what you would do going ahead.
Absolutely.
Got it.
Absolutely. So internal DNA is now built around our vision statements. We did that in 16 and we pushed ourselves hard to get to 22 without compromising on the foundation and by taking long-term calls, not short-term. That is why I say our business is not about quarters, it's about years. And every year we have to make a difference. That is the key.
Sure.
So similarly, now the entire organization is geared up towards 2027. Obviously, our internal targets are slightly more aggressive, so that we definitely don't fall short on what we've talked about for 2027.
Got it. And last question, really, as you look at where you are versus what you were, say 10, 15 years ago, as the case may be, do you yourself think that far out about what you might be 15 years out? I know you told me that 3 years later there might not be a ordering kiosk. 5 years later there could be something else. But do you think that far out for a brand which might be there for perpetuity?
The only way I think about that is in terms of very high level stuff. Where the consumer experience is going to be is undefinable today. You can only see 3 to 5 years and maybe even only 3 years. And therefore I say that we have to evolve every day and we should be unrecognizable every 3-4 years. So that part I'm not able to define where we might be. But I can tell you one thing, 10 years later, we'll be 3 to 4 times our size. We'll have more than 25-30,000 people working for us. There's no question. And our supply chain, which is backward integrated to farms, the impact we've had on the Indian agriculture is phenomenal on the food processing. And from wherever we are, it's only going to be 4 to 5 times more. So that I can visualize. But in what shape or form, that is to be determined.
Well, inshallah, all of that happens well.
Thank you.
But Amit, pleasure talking to you.
Thank
Pleasure
you.
coming to your store. Thank you so much for spending the time with us.
Thank
today.
you. Always a pleasure talking to you as well.
Thank you so much. And viewers, I hope you got a good flair of how consumption as a space might be as well, and what would be Westlife's and McDonald's role within that. Thanks so much for tuning in today.